Imagine a pair of shoes sitting on a clearance rack for 20 bucks. Nobody wants them. Now picture a limited edition sneaker release where pairs resell online for thousands of dollars within minutes. Let's say a highly anticipated sneaker drops, and the company only manufactures 500 pairs. But there are 50,000 people desperately refreshing their web browsers trying to buy them. That massive army of buyers willing to pay top dollar for those few pairs is what we call demand. Because so many people want the exact same item, sellers hold the power. They can ask for almost any amount, driving the price straight up. Fast forward a month. The shoe company sees how popular the design is and decides to flood the market with 100,000 additional pairs of the exact same sneaker. Now, the market is completely saturated. This is supply. There are far more shoes sitting in warehouses than there are people left who actually want to buy them. To get rid of all that excess inventory, sellers have to keep lowering their asking amount. They slash tags and offer discounts, causing the value of those once rare sneakers to crash. This leads us to the single underlying reason a price moves in any financial market. Whether you are trading stocks, foreign currency, or digital assets, the price rises or falls strictly because of an imbalance between the number of buyers and the number of sellers. If we took the daily resale price of that sneaker and plotted it on a graph over an entire year, the resulting line would look exactly like a traditional stock chart. Studying this historical footprint of price movement is a practice called technical analysis. Technical traders often ignore company news or quarterly earnings reports. Instead, they look purely at these historical chart patterns to figure out how the crowd of buyers and sellers might react next. This chart shows areas where price historically stopped falling and bounced upward. Traders call these demand zones, spots where buyers pushed the price back up. Conversely, supply zones are where upward movement halts and price falls, as sellers took control, forcing the value down. Technical analysis does not predict the future. It maps the visual history of a battlefield to show you exactly where the buyers and sellers are stationed. Zooming in closely, we see that the jagged line on the chart is actually made up of individual data points called candlesticks. Each one tells the story of a micro-battle over a specific period of time, like a single day or hour. This diagram shows a bullish candlestick. The green shape proves buyers won during that time frame, driving the price higher from open to close. Next is a bearish candlestick. The red shape indicates sellers took control, pushing the price down from open to close. Reading one candlestick is easy, but a trader often needs to process thousands of these data points at once to see the bigger picture. That is where technical indicators come in. Indicators are mathematical formulas that process past prices and volumes. They act like the gauges on a car's dashboard, giving traders additional metrics to help navigate the road ahead. This chart displays colored lines tracking through the daily price fluctuations. By calculating the average price over the last 50 days, the line smooths out all the daily noise to reveal the true momentum of the current trend. These dashboard tools don't make trading decisions on their own. They simply translate raw historical data into readable metrics, helping traders spot underlying market imbalances much faster. When you open a professional trading platform for the first time, you are greeted by a screen fully loaded with red and green candlesticks, shaded zones, and colorful indicator lines. It looks like a chaotic matrix of random noise, but you now know it is the exact same story as that limited edition sneaker drop. Every single shape and line on that screen is part of a visual language designed to track an endless, ongoing tug of war to see whether buyers or sellers are currently in control. No chart pattern, historical zone, or mathematical equation can predict tomorrow's price with total certainty. The market is always adapting, but by understanding the engine of supply and demand, reading the map of technical analysis, and checking your dashboard indicators, you stop blindly guessing. You learn to read the financial weather forecast, and you navigate the markets with a clear sense of direction.